Today is the 1st of August 2022. My name is David Hickson, and in today's video we're going to be taking a look at gold. Thank you very much for your feedback on last week's market update. I will certainly be recording some shorter market updates, but I was also asked to provide analysis details where it was important, and I believe that in gold at the moment we need to spend a little bit of time discussing those details, so that is what we will be doing. And just a reminder, if you are not already on our Discord server, then please join us there, because that is where we will be extending these discussions. So let's take a look at gold, and this is the analysis that I was discussing in the previous market update about gold. The important thing, as I mention every time I speak about gold, is that in my opinion a peak analysis is more important perhaps, or more relevant than a trough analysis when it comes to gold. And that is because of the fact that gold seems to behave as if though it is influenced by cycles that are synchronized at their peaks as opposed to being synchronized at their troughs. I've discussed this in previous market update videos about gold, so I'm not going to repeat the whole discussion here. I would encourage you to go back and take a look at previous videos about gold that I have recorded so that you understand the details of that consideration. And so in terms of the peak analysis in gold, the important things are that we had a 9-year cycle peak back here in 2011, and then we experienced another 9-year cycle peak. In my opinion, this was in 2020. Earlier this year, we witnessed an 18-month cycle peak, which of course we discussed in these market update videos. Now you will notice that on this chart there is of course also a trough analysis, and I find it very useful to keep an eye on the trough analysis because it can provide us with some useful information. But you will also notice that the trough analysis occasionally has some anomalies. For instance, this 9-year cycle trough over here at the end of 2015 looks like a good clean trough. However, this 9-year cycle trough in 2004 is not so obvious and might potentially be a bad placement for that cycle trough. We had a much clearer trough, of course, in 2008. But the number of years between 2008 and 2015 being about 7 means that this particular wave of this cycle doesn't really fit very cleanly into Hurst's nominal model. Which brings me to a discussion of Hurst's nominal model, which of course was originally defined around the analysis that he performed on US stocks. He dedicated a fairly extensive section of his cycles course that he wrote in 1970 to a discussion of the cycles that influence gold. And he proposed that those cycles run a little longer in gold. However, there are some gold analysts who believe that the cycles that influence gold are indeed shorter than the nominal model that we use in stocks. In particular, I would encourage you to go back and take a look at a webinar that I recorded with the late John Eastreich, who was a very experienced gold analyst and trader, and he believed that the cycles that influence gold are indeed shorter. I'll place a link to that webinar in the description below this video so that you can go and take a look at the cycles that he was discussing. That was probably about 7 years ago, I believe. So let's zoom in and consider what it is that I was discussing in the previous update video about gold, which was basically that I was feeling fairly bearish. Let's zoom in and take a look at this period of time up until about the end of 2023. And let's display the composite model line, which is a really quick and easy way of visualizing the analysis as it is on the chart. Let's add a few shorter cycles in there. There we go, and you can see the composite model line is suggesting that gold is moving down, as mentioned in the previous video, from this 18-month cycle peak down to this 18-month cycle trough in early 2023. And for that reason, I presented a bearish argument in terms of gold. But now if you go back and take a look at that video, you will know that I was also expecting an 80-day cycle trough to form. I discussed the fact that I had positioned the 40-week cycle trough over here in the middle of May, so I won't go through that again. But I was looking at price coming down into this 80-day cycle trough. Here is the nest of lows at the foot of the chart, after which it would bounce up and reach up towards this 20-week cycle peak. There we go over there. The composite model line presents that fairly cleanly. What has happened since I recorded that video is that a fairly obvious 80-day cycle trough has indeed formed in the price of gold. And as you can see, it came in pretty much bang on time. When people start working with Sentient Trader software, they often ask us, why has Sentient Trader not yet placed these diamonds under here for the 80-day cycle trough? The reason is because Sentient Trader is looking for confirmation that the trough has formed and that it is of the correct magnitude. Price has bounced up fairly steeply, which does call into question the 80-day magnitude. It makes us wonder whether maybe this could be a greater magnitude trough. Is it possible that this 40-week cycle pinning was incorrect? It is of course possible, but in terms of this analysis, this is the one that I am still focusing on. I still think this is a good analysis, bearing in mind, however, the fact that the trough analysis might be unreliable. Sentient Trader has not yet found enough confirmation that the 80-day cycle trough has formed, which is why we still have the nest of lows underneath the past price action. I often say that diamonds are not the trader's best friend. These nests of lows are much more important. We do not wait for diamonds to form beneath a trough before trading on the basis of the expectation that the nests of lows give us. So now, according to this analysis, nothing has really changed. Gold is bouncing out of its 80-day cycle trough and it is heading up to its peak over here, which will probably be a 20-week cycle peak. After forming this 20-week cycle peak, which it is expected to do in the next 2 or 3 weeks, we should find price falling again into the next 20-week cycle trough. And so for the now current 80-day cycle, we are of course expecting the price of gold to rise, form a peak in about the middle of August, and then drop down into a 20-week cycle trough towards the end of September, perhaps early October. That's what I'm expecting from gold. But now let's question the magnitude of this 80-day cycle trough. According to this analysis, I believe that is the correct magnitude for this trough. But I have a fascinating analysis to show you, which presents a very different picture for gold. I want you to hold on to the idea for a moment that the next or current 80-day cycle is expected to rise and then fall. Because when we have two different possibilities for an analysis, particularly for a long-term analysis, which is the case here, looking at the shape of that 80-day cycle is going to help us to determine, as price action unfolds, which is the correct analysis. So let me show you this other analysis, which is very different and really very intriguing. Here is the bigger picture for this analysis. This analysis is based on the initial cyclic model, what we call an ICM analysis. The initial cyclic model places more emphasis on the results of the spectral analysis performed by Sentient Trader at the beginning of the analysis process. When analyzing an instrument, particularly an instrument that is not a US stock, it is very useful to take a look at the initial cyclic model analysis because it might highlight different cycle lengths. I would like to spend a minute or two speaking about those different cycle lengths, but before we do that, let me point out the bigger picture here. And in fact, let me zoom all the way out. The first thing to point out here is that in this analysis, we have found an 18-year cycle. However, if you have a look at the wavelength, you will see it is nowhere near 18 years, which we'll be discussing in a moment. That 18-year cycle trough is over here at the low point in 2015. Then we had another 18-year cycle trough over here in 2002. Again, a questionable position for that trough, highlighting again the point that the trough analysis is not as reliable as the peak analysis usually is in gold. However, when looking at the other analysis, I pointed out this prominent trough in 2008, and if we measure the distance between those troughs, which I approximated earlier, you will see that that is just over 7 years. And a 7-year cycle is, of course, not a cycle present in Hurst's default nominal model based on his analysis of stocks. However, it is a cycle that has often been identified when analyzing gold. Now, if we take a quick look at the cyclic model table that has produced this analysis, you will see that the numbers in brackets here differ fairly substantially from the usual nominal model. In particular, you can see 7.8 years instead of the 9-year cycle, and only 11.9 years instead of the 18-year cycle. That's very short and a little bit questionable. Of course, the longest cycle in the cyclic model table is perhaps not as reliable as the others because there aren't longer cycles to really refine that cycle wavelength. However, the 54-month cycle has been found to be 41 months, according to the results of the spectral analysis. The 18-month cycle, 14 months. The 40-week cycle, only 32 weeks. The 20-week cycle, 15 weeks, and so forth. You will see that those numbers actually match fairly closely the cycle lengths that John Eastreich identified in gold, which is why I find this analysis a particularly interesting one. So, what is this analysis actually telling us? Well, while I've been talking about it, you have probably already noticed that this analysis suggests that the trough that has recently formed is in fact a trough of 9-year magnitude, which is pretty extraordinary. Let's zoom in and take a closer look at that. And I'm displaying the semicircles here because the semicircles give us quite a quick visual reference to the regularity of an analysis. It is not absolutely required, but a good analysis usually has very regular semicircles. It is of some concern that this 54-month cycle over here ran so short and this one ran so much longer, which you can see by the different shapes of the semicircles. And the 18-month cycle breakdown during this 54-month cycle over here is very questionable. So there are many questions about this analysis. It's not a perfect analysis, but it does certainly raise a very interesting question, which is whether it is possible that the trough that formed in July is a trough not of 80 days or not of 40 weeks, as we were discussing in the previous video, but in fact a trough of 9-year magnitude. Let's display the composite model line. And let's take out some of these shorter cycles so that we can see the composite model line a little bit easier at this scale. And let's zoom in so that we can match it to what we were looking at earlier. You can see that the composite model line is indicating that the 9-year cycle trough is, of course, going to be the beginning of a new bull market in gold. Price has not fallen nearly as low as it would have been expected, according to the cycles found in this analysis, which again calls into question the validity of the analysis. However, I think it's really useful to keep an eye on the initial cyclic model analysis, particularly in light of the fact that the cycles that influence gold are definitely of slightly different wavelength to the cycles that influence stocks. So now, how are we going to move forward? How are we going to make sensible trading decisions on the basis of the fact that we have either an 80-day cycle in a bearish market or possibly a 9-year cycle in what would be a very bullish market? What you do will depend very much on your time frame when it comes to making investment or trading decisions. But I will show you what I do, and we can discuss the shape of the next 20-week cycle and the next 80-day cycle. Let's start by comparing the next 20-week cycle, or perhaps I should say the current 20-week cycle, because there is no doubt that a trough formed in the middle of July. Here is the M shape of that 20-week cycle, according to the analysis that has a 9-year cycle trough lying behind us. Price is expected to move upwards into a peak in about the second week of August. You might remember, and we'll take a look in a moment at the other analysis, but we had a similar situation with price rising up to a peak at about the same time or perhaps a week later in the other analysis. Then price is going to fall into this 80-day cycle trough over here in the middle of September. Now here is a difference that you might remember from the other analysis that we looked at, which had the next 80-day cycle trough occurring at the end of September. Why is that? There are two possible reasons why this trough is expected to occur earlier. The first is that, of course, we're working with a different nominal model that has shorter cycles, and so, of course, the cycle troughs will occur earlier. The other reason, interestingly, is that if we are in a bullish market and that 9-year cycle trough has formed, then we would expect troughs of all the shorter cycles to tend to occur earlier. It is something called time translation that Hurst discussed in some detail in his cycles course. Following the formation of this trough in about the middle of September, price is expected to rise again to form this 40-week cycle peak. You can see we have a very staggered nest of highs over there, but that peak is expected towards the end of October, after which the price of gold will come down again to form a 20-week cycle peak over here in early November. You can see that generally the M shape over the next 20-week cycle is a fairly bullish shape. Now let's compare this to our expectation according to the other analysis. Here we are looking at the same period of time, and again, price is expected to move up into this 20-week cycle peak over here, which, as I mentioned, is in about the middle of August. Then price will fall into a 20-week cycle trough, expected towards the end of September or early October. So a later trough than would be expected in the other analysis, and also you will notice a much lower trough, because the general M shape of this cycle is definitely a bearish one. Then price will rise into this peak over here, expected towards the end of October, before falling into this trough over here in early December. You will notice that the four legs of this M shape take longer to form in this analysis than in the other analysis, and that is certainly a feature of a more bearish market. Sometimes people imagine that performing a Hurst cycles analysis means that we are looking into a crystal ball and forecasting the future. That is not true at all. We are developing an expectation of what will happen. As price action unfolds, we can compare the unfolding price action to our expectation, and we can refine our analysis. And that is exactly what we're going to be doing in this situation. Let's zoom in and take a look at one cycle shorter to see exactly how we will do that for the current 80-day cycle. If tracking price action over a 20-week period is too long for you because of your trading time frame, then of course you can look at shorter and shorter cycles. You could even go down to the intraday level and start studying the cycles that play out over 5 days or even 2 days and so forth. Here is our 20-day FLD. You know, I'm sure by now, that I track the interaction between price and the FLD, and the 20-day FLD is a very nice, reliable FLD, and it's a particularly good one for the kind of time frame that we're looking at in these update videos. And so, following a trough of at least 80-day magnitude, we will experience price crossing above the 20-day FLD, which it did, and it generates a target which I believe was reached on Friday. The next thing that we need to observe is how far above that target price reaches, because if this is a particularly bullish market, then we would expect it to exceed that target. If it doesn't get much above the target, then the market is clearly not very bullish, and we might be considering the bearish scenario. Then, at about the time that the first 20-day cycle trough is expected, we would expect price to come down and find support at the level of the 20-day FLD. That will be a critical moment for determining which of these two analyses is indeed the correct one. If it is this analysis, which is the more bearish one, then we might find the price doesn't find support but actually even slips below the 20-day FLD. At about the time that the 40-day cycle trough forms, we would expect price to cross down below the 20-day FLD to form that 40-day cycle trough, which is not a very clear trough in the composite model line. The reason for that is because the longer cycles have had a greater amplitude recently, and they've been more influential in price action. Then, of course, we would expect price to cross back up above the 20-day FLD, which, of course, we can't see yet because the 20-day FLD is median price displaced to the right by half the wavelength. So we need to wait until price gets there before we can see where that FLD is. But we would expect price to cross back up above the FLD, form a probably lower peak according to this bearish picture, and then come down into the next 20-week cycle trough over here at the end of September. Let's quickly compare that to the other analysis. Here is roughly the same period of time and of course our 20-day cycle FLD. Price crossed above the 20-day cycle FLD, which is in a slightly different position because remember the FLD is displaced according to the recent wavelength of the cycle that it is based upon. The target for price crossing the 20-day FLD was reached on Friday and ever so slightly exceeded, which is looking good for this bullish interpretation. At about the time of the 20-day cycle trough forming, we would expect price to find support at the level of the 20-day FLD. You can see that the composite model line is so bullish that it doesn't even bring price back down to the level of the 20-day FLD. It expects price to find support much higher than the 20-day FLD, which would be a very bullish sign. If that is what happens, then we are going to have to pay more attention to this bullish possibility. Then price will rise up to this peak over here in about the second week of August. Then it will drop down into the 40-day cycle trough. Again, by that time, we should have a 20-day FLD. We will monitor very closely whether price finds support at the level of the 20-day FLD, perhaps, which would be a very bullish sign, or whether it crosses down below the 20-day FLD and achieves its target to the downside, which would not be bullish. Then, of course, we will experience price coming up and forming a second peak before it drops down to form this 80-day cycle trough. The big difference here, of course, is that we are looking at a bullish M shape for this 80-day cycle, whereas in the other analysis we were looking at a bearish M shape. And so I'm going to be watching gold with a great deal of interest because it is either going to be bearish for many more months, or it is just possible that it has just formed a very important trough. As price action unfolds, we are going to discover one way or the other what is happening. I do hope that you found this market update useful and interesting. Don't forget to join us in Discord, where not only myself but many experienced Hurst Cycles analysts and traders are taking part in the discussion, and so there is tremendous benefit in joining the Discord server. You will find an invitation to the server below this video. If you have any questions, ask them on Discord or put them in a comment below this video. I look forward to hearing from you.